So securities lending and repo transactions, what are they? Well, they're basically one and the same. All it is, in simple terms, is swapping cash for collateral for an agreed upon date to swap back with or without an interest rate determined by the parties. Now, there's three types of repo transactions that occur on a daily basis in our markets. There is a government agency repo transaction, which is done between institutions. There is a treasury repurchase agreement, which is done between counterparties of the Federal Reserve through the reverse repo program, where the counterparties go to the Fed and they post collateral in the form of cash to buy up securities from the Fed. That way they can park their cash overnight to gain a small percent of interest to combat the rising inflation. Then you have other repurchase agreements, which are likely the ones involving securities that are related to fidelity. So now let's go ahead and take a look at the four corners of securities financing, the three types of repos, and what it all means. Now, before we begin, whenever you hear the word repo, that always means reverse repo at the same time. For example, every day at 12:15, I post a video going over the repo updates and where it's currently at. For example, today we were at $998 billion. That means today that between the 71 counterparties that use this program, they ran to the Fed with collateral. They were the ones providing the collateral. Therefore, they are the ones on the repo side. The Fed is providing the assets, so they are the one on the reverse repo side. Now, tomorrow, when they all meet back and they swap back because it's an overnight agreement, the counterparties against the Fed will become the reverse repo, and the Fed will become the repo, and back and forth, back and forth. If you look at the videos that I've made and the total amount borrowed, every time it rotates. So today it was a reverse repo. Tomorrow there will be a repo and then a new reverse repo. Rinse and repeat. That's basically all it is. So don't overcomplicate it. Again, these people overcomplicate this stuff on purpose, but it's all a facade. These people are idiots. Idiots. This stuff is not hard. They just make it seem like it is. So once you get past that, it's pretty simple to understand. So the four market segments, we have a securities lending segment, we have a leveraged investment fund financing and securities borrowing segment, we have an interdealer repo segment, and a repo financing segment as described below. Now note that the arrows that I'm about to show you in these little exhibits are pointing to entities that typically post margin or haircuts. Now, what is a haircut? A haircut is basically the amount that is over collateralized in one of these transactions. That's all that is. Let's go and take a look at Exhibit 1. So Exhibit 1, you have the borrowers right here, you have the lenders right here, and you have the agent lender right here. Now, we can put Fidelity as the agent lender because an agent lender is basically a custodian, and what a custodian is someone that has a lot of shares for safekeeping. So the insurance companies, pension funds, and investment funds can either send all of their shares that they want to lend to the agent lender for Fidelity to distribute, or they can send it directly to the prime broker, your JP Morgans, your Goldman Sachs, who then can have it rehypothecated with the Citadels or the Jane Streets or the Susquehannas right here, back and forth. So you can see already how you can lose track of what's what very quickly. Now, it is true. Insurance companies can lend securities. Pension funds can lend securities. So keep that in mind. Now, this part right here, this is the part where it gets interesting. Because if you have Fidelity here and you have commingled funds here, what a commingled fund is based on Supernote 9. These funds may be registered money market funds in the US or the EU. Okay. Then we have separate accounts. Now, what is that? That's a joint trading account that I'm about to show you that shows up on Fidelity's financial reports. So based on looking at the reports and looking at everything that's going on with 13Fs, we can assume that the pension funds in GameStop could be lending shares. The insurance companies found in GameStop 13Fs could be lending shares. And then all the investment funds that we see stacked in there could be lending funds. Is that to say that's what they're doing? No, it's just a possibility. So again, lenders in Exhibit 1 have the opportunity to lend through the agent lender or directly to the broker. And the broker would send cash collateral back to the lenders, who then can use that cash collateral how they choose, as long as when the time comes for maturity, all swapping back takes place, and then they just go ahead and start another transaction. Again, short-term financing. So to talk about the pension funds and investment and to see it, here's the 13 Fs. We have a Lincoln Variable Insurance Products Trust as an insurance company. We have a pension fund as State of New Jersey Common Pension Fund D. And then we have Harbor Investment Advisory as an investment fund example. Now, if we replace these with entities we know of in the market, our joint trading accounts, our joint trading account right here, look at this. It's found in Fidelity's financial report. This is as of 7/30/21, due 8/2/21. Obviously, this is an overnight government agency repurchase agreement. Agency lender, government agency repurchase agreement. Agency lender being Fidelity. Their own money market fund right here is where they reinvest the cash collateral given by the borrowers. So as you can tell, all this money or in shares and requests and borrowing and lending, it's all going through either Fidelity's agency lending account, BlackRock's agency lending account. There's several of them, but just for an example, I put Fidelity here with Fidelity's broker dealer here, because once they get the lent shares and the borrowed collateral, they can reinvest that collateral into their own money market fund, or they can put it into the joint trading account, for what point they can give back to the broker dealer, which is how Fidelity stays on its feet. So this is the securities lending segment. Now let's look at the leveraged investment fund financing and securities borrowing segment. Now this is likely what goes on under the table between broker dealers not using the 1215, 1245 window. So this is securities lending and margin lending takes place here, as well as leveraged investment funds. Like this is how you get your hedge funds to basically leverage their long positions by the banks and broker dealers using both reverse repo and margin lending secured against assets held by the prime brokers. So basically what they do is the assets are held by the prime brokers, and these leveraged investment funds will go ahead and they'll lend, brokers will lend securities and margin to the leveraged investment funds, who then will use those to have a repo financing transaction with a broker dealer to inevitably short the stock. Now, what's interesting about this is that the cash proceeds of short sales by hedge funds in turn may be used by prime brokers as cash collateral for securities borrowing. So the hedge funds go in and short the stock, and then they use the profits to give back to the banks as collateral, at which point they can use that same collateral to go and borrow more securities. And you can see how it just can get out of hand very quickly. And then on top of that, hedge funds may give the prime brokers permission to rehypothecate assets, usually up to the proportion of their current net indebtedness to the prime broker, which is 140% in the US. Now, if you remember, didn't we just get a bank open up a rehypothecation separation account in the European region? You know why they did that? Is because this 140% cap is much, much higher in the EU. So this is another type of financing transaction that goes on involving repos. Now, the leveraged investment fund financing and securities borrowing segment, the interdealer repo segment, Exhibit 3, comprises primarily of government bond repo transactions amongst banks and broker dealers. This is likely what goes on during that 1215, 1245 window, along with everything else. But this is the one from the Federal Reserve. In 2019, the Federal Reserve became a cleared central counterparty, or a clearing central counterparty, for this purpose. Interest rates were all out of whack. The banks didn't like what they were getting from their counterparties, so they ran to the Fed and begged them to be the counterparty to get the interest rates that they wanted. Now, these transactions are predominantly an overnight maturity, which further signifies that this is the reverse repos that we're seeing from the New York Fed. Total repos and reverse repos outstanding in 2012 was 2.1 to 2.6 trillion. That's outstanding. 8.3 trillion in Europe and 2.4 trillion in Japan. That's data as of from the Federal Reserve data for the U.S. International Capital Market Association. Now, right here, Supernote 12 says that prime brokers may also borrow securities, usually fixed income, in the interdealer repo market segment. So, for example, a client with $500 in custody of assets, of which 200 has been borrowed against. This is like if you had your share lending turned on. Let's say you had $500 of GameStop sitting there, and let's say they borrow against it from $200. They can actually rehypothecate that and borrow up to 280 due to that 140% threshold. Now, let's take a look at this. Exhibit 3, the interdealer repo segment. So imagine 12:15 hits. That video comes out, and you're wondering what the hell it means. So all these counterparties come to the Fed Reserve's repo program. Fidelity and JP Morgan are the examples here, okay? Because if we look at Fidelity's other repurchase agreements in their financial reports, we can see that other repurchase agreement doesn't fall under U.S. Treasury because of why? They're not going through the Fed. So how do they do it? Through a bilateral repo. Now, what is a bilateral repo? Simply means it's not going through a centrally cleared entity like the Fed Reserve. So follow the line. Fidelity wants to do a bilateral repo with JP Morgan. They exchange cash for collateral amongst their own shadow terms, at which point the only hinting you can get of this is right here on their financial reports, which we can see right here, JP Morgan Securities LLC, other repo agreement. And these are not necessarily overnight on this one. So if you're going through the central counterparty, typically overnight. But if you're going bilateral, not so much. Now, what's interesting is the maturity date on this is the 3rd, okay? Or that's when the maturity begins. So keep that in mind. So that's basically what's going on 12:15. Counterparties run to the Fed. They buy up assets from the Fed. The Fed takes in the cash. They take the cash and they park it overnight. It gains a small percent interest. The next day, they all come back and switch it all back and forth. But the problem is how much of it's been rehypothecated, reused, repledged. It can get to be a nightmare. Now, Exhibit 4.
Now let's talk about the
So Exhibit 4 comprises repo transactions primarily by banks and broker-dealers to borrow cash from cash-rich entities, including central banks, retail banks, money market funds, securities lenders, and increasingly non-financial corporations. As described in the next section, the drivers of this market segment are primarily the short-term financing needs of banks and broker-dealers, as well as the desire of institutional cash managers to hold collateralized money-like investments. So look at this one. This is Exhibit 4. Now, if we go back to the financial reports from Fidelity, look at all the joint trading accounts they have. They have Citibank, Citigroup, Credit Agricole, they have HSBC, Nomura Securities, RBC, Wells Fargo, TD Securities, Goldman Sachs, Bank of America, Bank of New York Mellon, Bank of America Securities. Holy shit. Now, why could this be? Because they're engaging in separate U.S. government agency repo agreements at the same time they're doing all these other agreements. This is all happening during that window of time, 12:45 or 12:15 to 12:45. All this exchanging of cash and collateral is going on. That's basically all it is. It's a group of parties with designated tasks in this ecosystem to either provide cash, collateral, safekeeping, or clearing. Now, we know that most of these entities are the ones posting collateral in the form of cash to buy up assets. Now, that's from the Fed. Now, what goes on between the institutions themselves outside of the Fed, we can only get hintings of from the financial reports. But considering the exposure levels that we're seeing to Fidelity, which I'm about to show you in a second, and the exposure Fidelity's getting from the Fed Reserve, it's insane. It's absolutely insane. Fidelity is sitting on a ginormous amount of cash. And if you look at the data here, what do you notice? Number one, where's Citigroup? Number two, where's Citibank? Where's Credit Agricole? The only one on here that I see is Wells Fargo and HSBC. All other joint trading accounts with Fidelity, I don't see on here. Could this be a way for them to have a tri-party repo not using the Fed? Because if the Fidelity is the intermediary, and let's say BlackRock's on one end and Citibank's on the other end, or JP Morgan's on one end and Citibank's on the other end, you really don't need the Fed because each of these entities have their own clearinghouses. So again, not only Treasury repos are at play here. It's multiple types of repos, all happening at the same time, simply meaning cash for collateral with interest. And based on the data, it looks to me like the ones requesting securities is literally everyone but Fidelity. Look at this. On 6/30/2021, 290 billion in demand from Fidelity alone. If you add up JP Morgan, BlackRock, Goldman Sachs, Northern Trust, and Federated, it still doesn't equal Fidelity. So why does Fidelity have more demand as far as the repo market than anyone else from the Fed? Because they have the most money and they need it to be parked because inflation's skyrocketing. And how do you combat inflation? If inflation goes up, the value of the dollar goes down. If the value of the dollar goes down and you're sitting on a shit ton of dollars, that's not good. You need a way to park that overnight and earn interest on it, which is exactly what the RRP program from the Fed Reserve is designed to do. Now, if we go look at the U.S. money market funds investments in the repo market, take a look at this. We're going to do U.S. money market funds investments in the repo market. This is the repo market, not through the Fed. Okay? And it breaks it down for us. So if we want to go through the Fed, we go here. If we want to go through the government agency, we go here. Other repurchase, we go here. Let's look at other repurchases first. Let's look at the counterparty types. What is the first thing you notice? There's no Fidelity listed as a counterparty. Why do you think that is? Because they're the ones that are taking in all of the collateral from these desperately in need banks and broker-dealers who need this stuff. So JP Morgan Chase, let's see who they're exposed to the most. Let's take a look. What do you know? Fidelity. That's interesting. Let's drill down a little bit further. Fidelity's government cash reserves is their number one exposed counterparty, followed by money market portfolio, followed by prime money market portfolio, followed by Fidelity money market. All of these are involved. And then you even have a Fidelity Securities Lending Cash Central Fund, which if you look at the principal data for this and you drill down to it in Excel, I'll link this below, by the way. Fantastic website. And you look at the data. Look, there was absolutely no demand, basically, until when? We didn't really start seeing it skyrocket until that April area. But still, nonetheless, pretty exposed as of December 23rd to Fidelity. And this is from JP Morgan. Now remember, they have a joint trading account together. Or I'm sorry, not a joint trading account together, but they have an other repo transaction together. So JP Morgan is exposed most to Fidelity. Now what? Let's go to the repos with the Federal Reserve. Now this is where it gets weird, okay? Obviously Fidelity is going to be the number one exposed to the Federal Reserve, okay? And I'm talking like 34% of the demand that day. Up until today, this was the second highest day we've ever seen for demand in this market. And we had Fidelity just completely take up almost half of the entire demand. Actually, I think I'm in the wrong spot, but that's through the Fed Reserve. So this is through your Treasury repo. Fidelity's the number one. Why is that? Because they're the ones parking the most cash to earn interest rate overnight. Now, let's look at the repo market again. Let's do government agency now. Let's see who the counterparties are to the government agency. Weird. No Fidelity again. Interesting. It's almost like everything but Fidelity is here. Why is that? Well, because Fidelity is the central counterparty to all of these players. That's why you go to Royal Bank of Canada, drill down the data. Guess who's number one? Fidelity. You can't make this stuff up. Now let's go look at the repo market again, and let's look at Treasury repurchase agreements. Drill down. Who's the number one counterparty for Treasury? Well, that makes sense. It's the Federal Reserve. But you know what's interesting? I don't see Fidelity on here either. You know what that means? That means that Fidelity's amongst one of the only people not using the Fed Reserve. You know why? They don't need to, because they're getting the money from everyone else. From all these mofos. Let's look at who the number one exposure to the Fed Reserve is. We just looked. It's got to be Fidelity. Yep. What a surprise. So hopefully this is all making sense. All this is a big mess of all these people running and exchanging this and that for this and that. And it's a mess. As we saw in the last video, this is exactly what happened before the crisis of 2008 unfolded, as Europe wisely discovered and pointed out in that document. So real quick, let's do one more. Let's go back to the repo market. Let's go to the Treasury repurchase agreements again, drill down the data, and then let's just let's pick one. Let's go to Citigroup. Let's see what they're exposure to. Now, my guess, because it's Citigroup and they have their own like custodial service, and they don't necessarily need Fidelity, I would assume the Fidelity will not be the number one as far as. Okay, cool. Yeah, BlackRock. So there you go. BlackRock's the one providing to banks, it looks like. And then we have Fidelity getting it up from all the broker dealers and investment funds, pension funds, things like that. So hopefully this makes sense, everyone. Again, it's just trying to overcomplicate this kind of stuff. It's just basically saying they don't have the means to finance these transactions, so they have to do it amongst themselves with like these joint trading accounts. And I'm going to look into this stuff next. Where's Bank of America's demand? Where is it? It's zeroed out all year long. Where American funds zeroed out until June. State Street was zeroed out until May. Guess when Fidelity launched their agency lending program? April 28th. If you look here at the demand, what happened between April and May? Almost tripled Fidelity's demand. Almost tripled, exactly tripled JP Morgan's demand. Doubled BlackRock's demand. Goldman Sachs almost doubled. Federated quadrupled. Morgan Stanley went from 2.9 billion to 44 billion. I mean, Fidelity's the centerpiece, man. It's gonna be it. Damn, this video took way too long. I'm so sorry. Golly, hopefully this makes sense. This stuff's hard to explain. But it's hard to explain because it's so overly complicated, but it's really not. It's really not. So hopefully that made sense. If it doesn't, I'm sorry. I do as best I can to explain this stuff. I love you all.